Okay, I do want to let you know that a very important person had a birthday today, and that would be me. And apparently some people last night thought we should celebrate with some stupid liqueur shot. I think that was Brittany that bought that for me. So when I got home and talked to my wife, I was talking Russian, and so she knew something was weird. Okay, so my name's DC Couch. Most of you guys obviously work with OCI, so you know me. But what we're really here to do today is to talk to you about the Medicare magic, turning Medicare sales into money sales. And my name's DC. I've been in this business for well over 30 years. And I started out as a multi-line salesman. I managed an operation for 20, 25 years, a captive agency. And as a matter of fact, probably would still be working with that firm today had they not changed their distribution system. I woke up one morning and they had cut my compensation by about 75%, made me an employee. So I decided maybe I'll move on down the line after 25 years. So I went out and I started my own agency in the health arena. And so I had a group health shop. I founded that thing with a partner who still has that firm. But meanwhile, a wholesaler came and grabbed me. He said, DC, you've always been one of our top producers. I'd like for you to come and start my life shop. So I went into a wholesale shop in Kansas City and started their life division. Meanwhile, this little fellow over here to my left was kind of coming through the ranks also. And he and I have been working together for a long time. And he said, DC, if you ever have an opportunity, I'd like to work together with you again. So I hired Aaron in that shop. And so we've just kind of been together for a long, long time. I'll let Aaron introduce himself. AC, you want to go for it?
You can't get rid of me. So, this first agency that he started or that he worked for, it was Kansas Farm Bureau, and he actually hired me as an agent there in 2001. And I went to work as a multi-line agent. I had a P&C block, but I was there because I wanted to sell life insurance. I wanted to sell annuities. I wasn't from the Kansas City area. I didn't know anyone, so this was kind of a natural market that he gave me. And I learned enough about P&C insurance to go to my clients and say, hey, I want to review your policies. Then I had this one line that I would say at the very end of that, car and auto and homeowner review, and I would say, well, tell me where you have your life insurance. And that's how I got started in the business. And so, same thing with DC. They didn't make me an employee when he left, but the company did go through some changes, and I lost some business to an independent agent once upon a time because I was trying to sell a fixed annuity, but the client actually was educated about an index annuity, and I didn't know what index annuities were, and that was my introduction to them, was me losing business to one. And I decided at that point that if I was ever going to not get a client because it didn't like me, that's one thing, but it was never going to be about product again. And so I went independent. He can't get rid of me. I kind of followed him around a little bit, and like he said, he hired me again in 2012. And then he talked Nick and hired me here at OCI just 3 months ago. So I'm new to OCI. I'm not new to the business. I just don't know where all the light switches are here yet, but I'm learning, and I'm anxious to share some secrets with you guys today.
So the reason that we tell you that is not, just a little bit about our background, is that we bring a little different angle to the sales process because we've done it. We've been in the field. We understand what it's like. So next. So why are you here today? Well, one of the things that OCI does that I really like is that we're going to provide you with an opportunity to improve your business. Because we know that where I sat in the annuity and single premium life world, that a large majority of the growth that we get in that part of our industry is coming from med-sup agents. And I know that not everybody in here is going to walk out and say, oh man, I love this DC, I'm going to take this, I'm going to improve my market space, I'm going to improve my profitability. But I do know that if we can get 1 or 2 or 3 of you to do this, it's really going to impact your life. So remember, the growth that's coming in this part of this segment of our industry is coming from people like you in your business. All right? So back one more. So why are you here? This is why you're here. Over $220 billion last year was placed into annuities and single premium life. $220 billion. $100,000 is about our average annuity premium that we take in. The average commission on that's probably going to be anywhere from $5,000 to $7,000. A single premium life, which we're going to focus a little bit more on today because it's really a simple sale. We think you guys will like it. Our average, again, is about $100,000. And our marketing person should have put single premium life here, but they put annuity. That would be me. But the average comp on that's about $7,000 or $8,000. So think about that. That if you could go in and you could write one or two of these a month, just think what that would do to your bottom line. So who's really busy during the busy season? I mean, when we're doing bad stuff, you got no time, right? What happens after January 15th? Do you have time? So what we're saying to you guys is that you already have the market. I'm not asking you to prospect. I'm not asking you to advertise. I'm just asking you to follow up with your clients and ask a couple of questions, and we'll go through this. But what's important to me, and hopefully I can get this across to you guys, is that you've done such a good job building that base. And as a matter of fact, Aaron's going to tell a story a little bit later about somebody that we helped just last month with a single premium life product. Understand that when you walk out of that client's house, somebody else is going to walk in, right? So if I'm in there and I'm doing a hell of a good job and Kevin tells me that the average commission on a med sup policy is about $18 to $20, is that right? Some guy's going to walk in and say, hey, where do you have your IRA? Are you happy with it? Are you worried about market flexibility? And talk to them a little bit. And they're going to walk out with $7,000. So to me, if I can just teach you how to ask a couple different questions, we can take your revenue and turn it into an additional $50,000 to $100,000. That flies all over me right now. So that's what I hope that you guys will take and gravitate to. And I hope you guys understand that we're not going to ask you to be the experts. That's what Aaron and I do. So there's a couple of ways that we can do this, right? I think I was over and I was listening to Kevin and Chris talk about the 50-50 split case. We do the same thing here. If you're not comfortable with it, and again, Aaron will touch on this with single premium life, all you have to do is give us a name. We'll take it from there. You don't have to do anything. We'll split that commission with you 50-50. And I think over time, what you'll probably see is that, I mean, these guys are not, they're not members of the Mental Society. I think I can do this myself. And you'll quietly start moving us out the door, which is fine with us. But what I'm telling you is there's so much money in this business that we're walking away from that I hope that we can convince you guys to at least ask some questions. Okay, next. So as we kind of go through this, our call to action today is just as we go through this, if something kind of, trips your trigger here a little bit, write some names down. And when you get back to your office, pick up the phone and call us and say, hey, Aaron, hey, DC, I've got this guy that I visited with. Let's discuss this case. Let's see what we can do about that. And let's make this an action item. Okay, so, all right, that's fine, but how do I identify my prospect? So these are questions that we like that hopefully will get you guys to ask. If things go as planned, what's going to happen with your money when you're done with it? Okay, so if I've got $50,000 in the bank, I want to identify that money that if everything goes correctly in your lifetime, what do you see happening with this money? Well, I would like to give it to my kids. All right, that's a single premium life sale. If they say they'll need it for income, it's an annuity sale. Okay? Other ones that you can ask, are you happy with your returns on your CDs? These are your clients that you're working with. And I guess I would pose a question to you that what do people 65 and over, what financial instrument do they have that nobody else has? They have CDs. Do they have CDs in there because they love the interest? No. They have it in there because it's safety and they want to be able to access it. Most of them, 6 of 10, they tell us that they have it in CDs because they want to leave it to their family at some point in time. Well, if I can show you how to take that CD and leverage it up 30 to 60% and yet you not lose control over it, would that be something that would interest you? There's just little things like that. Aaron's favorite statement is, what do you think future tax rates are going to be, higher or lower? you shopped rates on your term insurance lately? I mean, there's just little leading questions that you could ask. How would you pay for long-term care if your spouse needed it? Do you know how to create a guaranteed lifetime income? Would you be interested in learning how you can get Uncle Sam out of your legacy? Tell me about your current life insurance portfolio. That's what that's what we taught Aaron to do years and years ago. All we're doing is asking them questions to get them to think and maybe give you a response. Next. So I'm not going to spend a lot of time on annuities because a lot of people think annuities are very, very complicated. But what I do want to show you is what an annuity will do. So if I'm asking you to get into the annuity business, a lot of people are going to have a wall come up and say, oh my God, I don't know anything about annuities. They're very complicated. I'm not very comfortable talking about my customers' finances. Again, we're here to be your professional. I spent 10 years with a firm that designed annuities. We were probably responsible for well over $20 billion of annuity sales. I know annuities inside and out better than anybody you're going to meet. I promise you. I can teach you annuities, but the fact is I don't have to. All I have to teach you is what an annuity does, right? So if I'm interested, I ask somebody, where do you have your IRA? Well, I have it with Ryan Ruth down here, and that guy's killing me. I mean, I'm losing money left and right. What do you got for me? So what we do in the annuity world, the bottom line with the indexed annuities is that we're going to conserve your money. We're going to conserve your principal. And we're not going to make you millionaires. But what an indexed annuity will do is that we're going to credit some of the upside of whatever market industry we're in, but we're never going to take a loss. So here's just a snapshot of 2007 to 2019. If we put $100,000 in the S&P 500 with a 1% fee, and we put $100,000, I believe this is in a Lincoln one-year S&P 500, I believe that's a 45% par rate. Yeah, 40% par rate. And we let it go. We know that from 2007 to 2008, we didn't have much of a gain. So neither financial product made much of a gain. But we know what happened in 2008 to 2009, and that's the market crash. It took over a 30% decrease there. So if I had my money in the S&P 500 in the market, I promptly turned 100,000 into 64. But if you purchased a Lincoln annuity or any indexed annuity with us, we still maintain $100,000. We didn't lose anything. That's the power of an annuity. So as the market, we know when it goes down, it's going to rebound, but our product rebounds with it. So it actually takes, I believe, 10 years before you actually earn back in the S&P 500 what we would have had in the annuity all along. And then we had a big market influx, and then it went down again. So if you think about this as what we're protecting right here. If you were ready to retire in 2009, which I was in the annuity business in 2009, I sat across the table from a lot of people that had millions of dollars, and 1 year later, they didn't have any. I mean, they were literally, they had to go back to work. So what affects you more, a 20% growth on your money or a 20% loss on your money? Most people that are getting ready to retire are going to tell you a 20% loss will really affect me. 20% gain, I really don't care. It's great. It's not going to change my standard of living. So this is what we do with an annuity, is we preserve your asset and we grow it steady, and we can turn it into a lifetime income. There's a lot of things that we can do with an annuity. Nick, you have any questions back there?
Great job.
I mean, you always wanted to know what an annuity was all about. So, any questions on annuities? Again, that's just one. I don't want to go into the details on a lot of them. We've got 20 different companies out there that we work with. Yes. My official answer is we do some work with them. I do none. I think Dan can probably find a way to get some variable annuities, but I know Ryan works a little bit in the variable annuity market. My philosophy always been about variable I'm just not going to risk any money. I had a variable license for years, but I gave it up because I had my variable license in 2001, 2002 when my clients got beat up. I had nothing to do with it, but they were pissed at me.
And it does take away from your safety.
Yeah.
It can. I think they've got some stuff built in there now, but I'm not an expert on them at all. I love these products. These are really great products. Anybody else? Yes.
They need an immediate stream of income. Is that something that you can?
We can. We do a lot of immediate. For some reason, I'm not a huge fan of it, but we can do immediate income. We get a lot of people putting $100,000 in and saying, "Give me a 10-year income." Yeah, we can do that. We're a broker. We can go shop it. We can go find the best deal out there for you guys, right? Remember, with an annuity, you can't put all your money into an annuity. We're only going to be able to take maybe 65% of it. And then, so what I've always told my clients is just give me the money that you don't want to lose. You go gamble the rest. But I'll have yours here for you, right? And then we can turn it on an income at some point in time. I have a lot of people that are 55 years old that call me and say, I've worked my entire life. I've got this little pool of money put together, $300,000 or $400,000. I really don't like what's going on in the world today. Is there any way I can save this and protect it? Because I can't afford to lose it. And as we all know, what's going on in today's economic environment, political environment, world environment going on. I mean, we could have a crash for sure. So I would be a little fearful of some of my money. That's what an annuity will do for you. It will protect you. Steve, you got any comments on that? You want to take over?
I'm just here to listen.
So DC, how do you overcome, we all read in any article, annuities are so expensive, and there's so many hidden fees, and only a con artist would sell one of those. That's what you're going to hear on all the radios and everywhere you read.
So if you Google annuities, well, you're going to get a lot of negative information on it, and typically most of the info is coming about annuities because of fees and expenses. And there are no fees and expenses in a typical standard indexed annuity. You can buy them with fees and expenses. So what the pundits do is they take an annuity that's crappy and they lump everything together. And so all annuities are crappy, right? The reality is they're not. I mean, they're very, very beneficial. I've been doing this for over 25 years. My clients have probably averaged about 5% over that period of time. And there's not one of them that are upset with that. Because what I tell my clients is that you're going to make anywhere from 3 to 5%. 3 to 7 on a good, on a good 10-year span. If you're happy with that, I'm your guy. If you're not happy with it, don't put it with me. So no fees, no expenses. 100% of your money works day one. Anything else? Randy? Keeping you awake after lunch?
Absolutely.
All right.
Riveted.
Okay, so that could be for MedSup, for individual health sales, that could be a good transition. And again, this is a way that and one thing that you never have to worry about is we're not going to risk any of the money. It'll always be there for you, right? So we're the experts. Get us involved. The next one that I want to transition into is something that's really growing in the insurance world today. As a matter of fact, there's some independent companies out there that are doing, a couple $100 million worth of this product each and every year. I know Brett's written 1 or 2 of these things. I know Aaron's written 1 or 2. This is a great product because we're really talking about now idle money. Money that's just sitting there, not doing anything. And Aaron, I'll let you take over from there.
So where I want to start is, I didn't want to interrupt, but Nick's comment about the Wall Street media machine or the people who want to bash annuities. One thing I always used to like to say out in the field was, does anyone know who Ben Bernanke is? I used to have an article, I'm sure you've seen it too, but he's a guy that might know something about money, about the economy, right? A large portion of his portfolio is in vehicles just like this. So, I mean, if it's good enough for him to buy it, it's good enough for the rest of us. The other thing too that DC mentioned was was that how much can you put into an annuity? 60, 65%? Because this thing we have that's called what? Suitability. So if you're not securities licensed, what are you going to do with the rest of the money? You're going to walk away from it, leave it on the table? And so the way I actually learned about wealth transfer was because that situation happened to me. Like DC, I gave up my securities license in 2005 and I decided to focus on safe money strategies only. And it was right around the time he hired me at the last company that I was sitting down with a client and, I was doing a review. It was actually a client that I inherited, and I was just kind of reviewing their policies, and I was looking for opportunities, something that I could do to maybe make a commission or, more importantly, help the client. And they said to me what every agent loves to hear as we're getting ready to leave. They're like, we appreciate this, what we have. I know you didn't sell it to us, but we've actually got another $100,000 over here that we need to do something with. We don't really want to put it into an annuity. Do you have any suggestions? And I didn't. I wasn't selling this type of strategy back then, so I didn't really know what to do. And I walked out of the conference room. I went to DC's office, and I was frustrated because I literally walked away from commission because I had nothing. I was going to have to refer that money to some broker that could go put it in some kind of managed account. And he said, well, why didn't you talk to him about single premium life? I'm like, what are you talking about? So he kind of took me through the process and helped me identify what questions to ask, how to determine whether or not the client was even a prospect for it, because I didn't know. And as it turns out, I did exactly what he told me to do. And guess what? I made a sale, and it was good for the client. And that, I guess I can speak. I know I'm new to all of you folks, but one thing I love that I heard that Charles said this morning is that, OCI is not an FMO. We're not a GA. We're different. We're OCI. And I think one of the things that we bring to the table is that we do have that field experience, and having been a personal producer for the last 20 years, and having worked with different IMOs, I can tell you we are different. Your other IMOs out there don't have someone that can help you guys do stuff like this. So I'm excited about taking you through this today, and I'm going to tell you that I'm not very good at selling. I'm not. But when I use what I'm going to show you guys today, I've got about a 95% close ratio. So if I can do it, you can. It is transferable. It's something you can take to the field in your very next appointment. I'm going to take you through it. And real quick, do we have any golfers in here today? If I were to ask you golfers, anyone like Tiger Woods? I know he kind of got drugged through the mud, but I still like him. I mean, the guy's trying. He's a good golfer, right? But if I were to ask you today, if you had a choice, would you rather have Tiger Woods' clubs or swing? Which would you rather have? His swing, right? Well, I'm going to share with you a club in a minute, but then I'm going to give you Tiger Woods' swing as it relates to this strategy. And I'm telling you guys, everything that you'll learn from me, from DC, as it relates to the sales process, it's field tested. In other words, we know it works because we've sold it ourselves. I had a mentor once tell me, fail fast and cheap, right? Get your mistakes out of the way. And my old man always just say, there's no shortcuts. The one thing you can't buy is experience. But man, if you can learn some things along the way that can help you get there a little bit faster, it'll benefit all. So I'm going to cruise through. This is supposed to take me about 27 minutes, and I've got 28, so I hope I do all right. But I learned from DC a long time ago that, it's not about the product, it's about the process. Anyone can throw a policy against the wall and see if it'll stick, but I believe that we've got the perfect storm for this strategy, for wealth transfer, for single premium life. You guys are sitting on it right now because the best place to find new business is in your existing clientele, right? And this is something that, with one of these questions that we saw up here earlier, I'm going to share with you that if you ask this question and your client answers it the way I know they're going to answer it, you are going to be able to put an element of predictability in your sales process. In other words, if you have a true prospect, there's, like I said, a better than 95% chance you are going to can get this done. There's no risk to the client in any way in this transaction, and I'm going to take you kind of through how I sell it. But first, I want to talk about kind of what's going on around us. Why do I believe that we kind of have the perfect storm for wealth transfer for single premium life? And it's because of this. Kenny just updated this slide for me a few minutes ago. But as of today, the Dow is sitting here at 28,422. Is it higher than its all-time, or what was the highest it ever got? Was it 29? 29. So it's not quite back to where it was. But the Dow is hovering right around its all-time high, right? Well, so we got our clients are sitting here and they don't know what to do, right? Because if they go into the market right now when the Dow is almost at its all-time high, isn't that kind of counterintuitive to what they've always been taught, which is to buy low and sell high? So they're sitting here thinking, well, I don't know what to do. I mean, I can't, the CD isn't paying me anything, but I got to do better than that, and I got inflation and all this, so where do I go? I like annuities, but I don't want to tie up my money for 7 or 10 years. I don't know what's going to happen. I don't know if I need the money. What should I do? And then the other thing, too, is if they are considering annuities, or excuse me, CDs, we know that the national average is less than 50 basis points. So it's not even keeping up with inflation. And then one thing we also have learned, I don't know about you guys, but for those of you that are out there talking about money with your clients, what portion of the client's money is qualified, would you say? Percentage? How much? The majority? Right. So one thing we know with that, I would say that when I was out selling actively every day, I would say that probably better than 85% of all annuities I sold were qualified to some capacity. It was an IRA, it was a SEP, it was something, traditional IRA, whatever. But most of that money was qualified. Now, what we also know is that we've got this unintended beneficiary that's kind of sitting around the corner. His name's Uncle Sam, he's waiting to collect his, right? And now what else happened in 2020 that kind of changed the way things are going to happen from a wealth transfer standpoint? Secure Act. That made a big difference on how money's going to transfer from one generation to the next. So we've got to find a way to get Uncle Sam out of the legacy, especially because we also know this, that over the next 20 years, we're going to see $30 trillion of wealth transfer from one generation to the next. And again, the majority of that's going to be qualified money. So we've got to find a way to do it. So how do we do it? I like to use single premium life. And there's a lot of reasons why I like to do that. We've got a number of different carriers. My very favorite product on the market right now is Sagicor. They've got a product called the Wealth Care. Or is that what it's called? I don't even know what it's called. But yeah, there it is, Wealth Care. I haven't given a name for it up there. But here's what it looks like. It is a single premium. It is most of the time a modified endowment contract. When I first got into the business years ago, a MEC was a bad word, right? You didn't want to make a contract. Well, the way that most people are used to selling life insurance without making a contract is you're doing something where you're overfunding the policy and you're using the minimum death benefit max fund. You want to pull out stuff later, right, for tax-free income. Different animal. The apples and oranges, right? This, for modified endowment contract purposes, this is a wealth transfer play. We're focusing on leveraging a death benefit first and foremost. That's the most important thing we're trying to accomplish here. But I want to talk about the club for a minute, and then we're going to get into the swing. So this is the club. It is a single premium life product. It is 100% liquid via ROP day one. What does that mean? That means that if your client puts $100,000 into the policy, there's a rider on that policy called return of premium. They can go bail out of that policy anytime they want. They can always, worst case scenario, no matter when it happens, they can at least go back and get their original deposit if they want to. So they've got an exit strategy, right? It has ABRs in most states. What's that? Does anyone sell anything with ABRs, accelerated benefits? Anyone sell any term insurance? Nobody? Just me? Okay. All right, so the way that works, and most everything that I sell in the life insurance world has some sort of ABR attached to it. Why? Because when I got into this business years ago, seniors then had two concerns. The first one was going into a nursing home, and the second one was outliving their money. Would you believe that 20 years later, those same two fears still exist? Well, back then, we didn't have products that could hedge those things. Now we do. So ABRs are huge. What it means is if your client cannot do 2 out of 6 activities of daily living, the life insurance company will accelerate the death benefit. Normally, it's around 2% per month until the death benefit is squeezed down to a certain point, then they've got just a paid-up policy. So ABRs, and they are tax-free because all they're doing is accelerating a future tax-free death benefit. When we sell this policy, we're selling it for wealth transfer. We're trying to leverage an asset first and foremost. We're selling it for death benefit. Then we're selling it for long-term care or for chronic illness protection. However, this thing does have strong caps and some growth opportunities. So over time, it could perform well for your client. It has an annual point-to-point cap as high as 12%. You can do 8% with no fee or 12% with a 1% fee. You can reallocate each year just like you can in an annuity, or you can go to the participation rate method of 65% par rate or 80% with a 1% fee, and then you've got a 2.5% fixed account. So I would argue that even when you strip out the cost of insurance, this right here still beats the banks, right? Which is what we're competing with. We're not competing against the guys on Wall Street for money like this. This is lazy money that's sitting around that DC said, what are you going to do with your money when you're done with it? Well, if they're not going to use it for income, they're going to pass it to the next generation. There's not a better place to take this. So that's the actual product. What does it look like? How do you qualify for it? It's not a traditional underwritten plan where you have to go and do a paramed and a blood and a UA and all that stuff. This is simplified issue. So for most carriers, it's about 12 medical questions. A lot of them are done through an e-app now. Some of them require a phone interview, and you get an immediate underwriting decision. So it's a quick process. It's going to pay annuity. It's going to pay comp like an annuity. So the example DC gave was, $5,000 to $7,000. $100,000 deposit is about what you can expect, and it'll issue up to age 85 with most carriers. And like I said, the process it's turnkey. The last one I did, it took about 20 minutes. Actually, the last one I did was a lady whose husband passed away. He had a bunch of life insurance, death benefit that passed on to her, and I said, why don't we keep this tax-free money tax-free? In fact, the nature of the product that we sold her was an e-app. I did the application over the phone. I was at my home office on like a Tuesday night, and I called her, and like I said, the whole thing took about 15 or 20 minutes. So that's the actual product. Before I go into, that was the club. Now I'm going to talk about the swing, but before I do that, is there any questions? One foot in the grave, one on a banana peel. No, I'm kidding. So it's a lot of them are like, in the last 10 years, have you had any of this? Or have you had more than one occurrence of cancer? My mother-in-law, I use this example with people all the time. She, up until about 3 years ago, would have qualified. When I first met my wife years ago, my mother-in-law was not my mother at the time, but she was battling thyroid cancer. Got through that, has been in remission for years. 3 years ago, she had a bout with breast cancer. That kicked her out. Not because she had, cancer, it was because she had more than one occurrence. It didn't matter, it was two different kinds. More than one occurrence of cancer will kick you out. Have you been diagnosed with diabetes prior to age 45? Are you on insulin? Have you had a pacemaker? I mean, stuff like that. It's stuff that the average person, like, I'll say our age, maybe. There's a lot of younger people than me in here now, but I would say, 45 to 50 or 60-year-olds, they're not going to be buying policies like this for the most part. These are people that are going to be probably 60 and older that maybe they had a heart attack, 5 or 6 years ago, not going to kick them out, depending on the severity. So what I always do with people, and we can provide you with what the typical knockout questions are, but a little trick I learned from DC once upon a time was, and he kind of taught me this with that client of mine that he helped me with years ago, was I had the knockout questions, and I said, okay, folks, I've got some ideas on what I want to do with your money, but before I get into that, would you mind if I ask you a few medical questions first? And a lot of times they're going to be like, why are you asking me medical questions? We're talking about my retirement planning. This seems kind of weird. And I say, look, when you buy your annuities, when you buy your stocks, when you buy your CDs, your mutual funds, you buy those with your money, right? Well, some of the tools that we offer, you actually have to buy with your health. So it's a really kind of non-threatening way to just kind of get around that. But does that help? So, and we can provide you with it. It's not, but it's really, if they're on a couple of medications, it's not going to kick them out. If they are diabetic, it's not going to kick them out. We do have some carriers that are either yes or no, like National Western Life, for example. When I say knockout questions, they are knockout questions. You answer yes, you're out. Now, we do have a couple other carriers that are yes, no, and maybe. Maybe meaning they might go out and order an APS. So we can, a lot of times what we have people do is just call us, let us help you qualify, kind of which direction to go and whether it's a fit for this. So back in the day when I was in the field, I used to do seminars with my dad. He and I had a practice, and we would go and invite 30 or 40 people to a restaurant, and we'd serve them a nice steak dinner, and we'd get up there and give our presentation, and we were trying to sell annuities. That was the purpose that we were there for. And the problem with that, it was good. I mean, for a lot of years, it was a good, practice. But the problem is, I also had on blinders. So I mean, I was there to sell news. All I talked about. The problem was, I left a lot of money on the table. The good news was, I had a captive audience to go back to and talk to once I figured this strategy out. Well, one thing I was good at was staying in touch with my clients. And if you're not currently doing annual reviews with the clients, I would encourage you to, because that is how you're going to find money. And Dennis and Christy came to a seminar a while back, and they decided to buy some annuities from my dad and I. And between the two of them, they gave us about $750,000. But for me staying in touch with them, I knew that Christy and her brother and sister owned their family farm, the parents' farm. And at some point, they were going to sell that farm. And I was really interested in that because I knew that the farm was worth $1.5 million, and Christy's share was going to be $500,000. And I knew a little bit about Christy and her circumstances. So I thought that, man, if she ever sells that farm, I might have a shot at going to get some of that money to do something with. I didn't know what, but I was going to do something with it. And so that day came, and I called Christy up, and I said, Christy, I'd like to invite you and Dennis into the office. I want to sit down with you and talk to you about this money from the farm sale. And she said, Aaron, I will come in and visit with you, but first of all, there's no guarantee that I'm going to do anything else with you. But even if I do, the maximum amount I would allow you to work with is $250,000. And I said, that's fine, that's fair. So she comes into the conference room and sits down, and I question is going to dictate what you do, because the purpose of the money is going to dictate where you put it, right? If this is nest egg money they're not going to use for a while, you can probably tie it up. Put it in a longer-term annuity, get some better caps and rates, whatever you want to, maybe an income rider, whatever. But if it's money they're going to need in 2 or 3 years, probably annuity's not a fit, right? Well, when I asked her that question, her response, I've told this story for years, and I wish I could say that I was making it up, because it's like she just pitched me a fastball right down the middle of the plate, and I just cranked it. Because she said, her exact response was, she said, Aaron, we don't really need the money. We want to keep it safe. We'd like to try and grow it if we can. The biggest thing is we just don't want our kids to have to pay taxes on it when we die. It doesn't get any better than that, right? And so I knew going in, I had an annuity option and I had the single premium life option. And I wasn't exactly sure where I was going until she said that. Once she said, I just don't want our kids to have to pay taxes on it again, I threw the annuity out the door. I knew exactly where I was going with it. And then my next question was, and this is the one I would ask you guys to write down and steal this and use it, because I promise you it works, is I said, Christy, what do you think future tax rates are likely going to be, lower or higher? And what do you think she said? Higher. Yeah, everyone says higher. After she stopped laughing, she said higher. And I said, you know what? I agree with you, Christy. I think future tax rates are likely going to be higher as well. Here's the problem that I see with that. I said, between you and Dennis, you have $750,000 in IRAs. And then I stopped talking. And I just kind of stared at her for a minute. She kind of looked at me funny. She's like, Aaron, how's that a problem? And I said, well, don't misunderstand. You've done very well for yourself. But I said, you have $750,000 in qualified plans. And she said, okay. And I said, at the time, she was 60. And I said, okay. I said, Chrissy, you're only 60 years old today. I said, you're not even to R&D age on this thing yet. And I said, you just told me you think future tax rates are likely going to be higher, and I agree with you. The problem that I see is that if these accounts continue to conservatively grow, by 4 or 5%, and when you start taking out your RMDs at 70 and a half, I said, even if you live the life expectancy and then you die, you could easily still have $750,000 in qualified plans that are going to transfer to your heirs in a tax environment that you just told me you think is going to be higher, and your kids are going to be at their highest income earning years, and they're going to get hammered with taxes. And she goes, wow, I hadn't really given that much thought before. And I said, I can't do anything about the taxes. IRAs and qualified plans are the greatest savings retirement or savings plan the IRA or the government ever created for themselves, right? Because they want to tax on before you die, and then they want to hammer your heirs when it passes to them. And I said, but what I can do is I can show you a way to either mitigate, reduce, or simply get Uncle Sam out of your legacy simply by taking money from your left pocket and moving it to your right pocket. And I tell that all the time, because that's all we're doing. I'm not asking you to spend money. I'm asking you to reposition it. All we're going to do is we're going to take an asset and we're going to optimize it. And in doing so, we're going to get Uncle Sam out of your legacy. Here's why. I had a mentor once tell me that the average American worker will work 90,000 hours in their career. That's a lot, right? We're insurance agents. What does that mean? That means that sometimes we have to work after hours, right? Sometimes we have to work on the weekend. When we're doing that, what is that? There's a word I'm looking for. Anyone know what it is? When we're working and we're not with our families, what is that we're doing? Sacrifice. We're making a sacrifice. Did you work? I asked Christy. I said, "Did you work all those 90,000 hours? And did you ever have to miss a ball game, or did you ever have to miss a recital for your daughter? Or did you ever have to miss any of that and make those sacrifices?" She's like, "Sure, I did." And I said, "Well, did you do that? Did you work those 90,000 hours and make all those sacrifices so your kids could write a big fat check to Uncle Sam when he died?" And she said, "No, we didn't." I said, "Well, let's talk about getting rid of them then." And what I was able to do for Christy was I took that $250,000 from her left pocket and I moved it to her right pocket. And I said, "Christy, here's what's going to happen. We're going to take that $250, and on day one, it's going to leverage it up to $500,000 in the form of tax-free death benefit day one. If we do nothing else, that's what happens. So your $250, when you die, is going to turn into $500,000. Now, let me ask you a question, because she was not going to the market with that $250. I knew I wasn't competing against that. I was competing against CDs. I was competing against just safe money stuff, right? Maybe muni bonds or something. That's what I was competing with. But I asked her, I said, "Christy, if you're not going to do this, and you're not going to let me take this $250 to $500,000, how long do you have to take that $250 and put it somewhere else to get it to grow to the $500,000 I can get it to day one today, guaranteed? Keep it in mind, you're 60. How long?" And the reality is she can't live long enough, right? She'll never get it to grow to the $500,000. But I said, let's take it a step further. If you get sick or hurt, you can't do 2 out of 6 activities of daily living, you can accelerate that $500,000, and it'll pay you 2% per month are based off the death benefit. And that death benefit has indexing as well, so it's going to grow over time. So it started out at $500,000, but it's going to be more than that the older she gets. So I said, we'll accelerate 2% of that death benefit per month until it's whittled down to $12,500, then you just got to pay that policy. And I said, in addition to that, we've got some really good caps in this thing, so it's kind of like your annuities where over time it can grow. So you could have a nice account value, by the time you're 70, 75 or whatever. So if you wanted to dip into it or do something else with it, you can. But here's the cool thing. That $250,000 that you gave me day one, that's liquid. So if life happens, if your world turns upside down, if you decide that you don't care about that death benefit, if you just want to go spend that money, maybe you decide you want to give the money to your kids now, you can always at least go back and get that $250,000. So what did I just do? I just gave you something that really sounds too good to be true, doesn't it? So what's the catch? Because I've had clients ask me before, well, this sounds really good. How can an insurance company give me all of those things? And so as an agent, and I believe in being transparent and full disclosure, I would say to these clients, here's the deal. Everything I told you is true. You're liquid, you've got this death benefit, you've got the ABRs, you've got the grow, you've got all those things. That's all true. You have no risk. There's no risk in this transaction to you. There is risk in it, but that risk is on me. And then they get real confused. Like, what do you mean? And I said, well, insurance companies pay guys like me a commission to sell their product. And the catch here is that if you bail out of this policy too soon, they come back and take one of my commissions. Now, my old man taught me years ago that you got to put the client first every single time, right? And I want to caution you because if you don't identify the right dollars going into this product, it could bite you. So I always say, make sure you identify the right dollars because we don't want to charge back on this thing, right? But I tell my clients, I say, listen, that's how it works. I am paid. If you bail out early, they take my commissions, but understand this isn't about me, it's about you. I just want you to understand how I'm compensated because if I've got a vehicle that I'm putting your money into and I'm leveraging your account up by 100% or whatever, and I'm giving you these ABRs and I'm giving you this growth and it's going to pass outside of probate and your death benefit's tax free, I'm giving you all this benefit on this $250,000 over here, but you got your other $250,000 over here doing nothing and you need money, where does it make the most sense to go get it from? Right? So when you identify the right dollars, it's not an issue. So then, I had this, I don't know, do you guys sell income riders at all in annuities? When they first came out, were they not the most confusing thing in the world to understand? They still are sometimes. Well, I found this really cool way to diagram. I'd draw it out, I'd write a line down a piece of paper, and I'd write account value, income account value, and I'd literally show the client how it worked. And so I became very visual with stuff like that. Well, years back, I came up with this analogy as well, and it kind of goes back to taking the client back to maybe something to make them feel the pain of like the 2008 and reminding them, when they had $3 million and then it went to nothing because of Wall Street did this on them, and just letting them understand how this thing really works. And so I would draw up on a grease board this bucket, and I'd put a dollar sign in the middle of it, and I would say, folks, for the purpose of this conversation, this bucket represents your money. This is all your money, okay? And inside your bucket, you've got a lot of hands. Okay, these arrows represent hands that are inside your bucket. And there might be more than this, but for all intents and purposes, you've got a fees hand in your bucket, you've got a volatility hand in your bucket if you're in the market, right? You've got an inflation hand in your bucket, you've got a taxes hand in your bucket, you've got your own hand in your bucket. My kids' hands are all over my bucket right now, right? My wife is insane in my bucket, right? So you might have some more, you might have your church, philanthropy, whatever, but this is what's going on, right? Well, what happens is when you've got all these hands in your bucket, you know what that does? It creates this thing called drag. Any pilots in here? Please say no, because I don't know anything about flying. I just know this part. Okay, good. So it creates a lot of drag. That's like an airplane thing, drag, right? Lift, drag, thrust, I think. But anyway, this creates a lot of drag when you've got all these hands in your bucket. And what it does is it puts tremendous pressure on this bucket to have to perform. Well, what if I could show you a way, Mr. and Mrs. Client, to one more time take that money from your left pocket and move it to your right pocket, and I can get rid of the fees hand, I can get rid of the volatility hand, I can get rid of the inflation hand. Why? There's a guy in town called Warren Buffett, right? He wrote this book. Anyone read Snowball? It's like this big. I haven't read it either, but I read one line in it, and he said the best way to fight against inflation is to not lose what you already have, right? So we can get rid of the inflation hand, we can get rid of the taxes hand, so the only hand in your bucket is your own. I've had clients before, folks, say that this is a no-brainer, literally, and I've actually positioned this to people and said, the question really isn't why would you do this, it's why wouldn't you? And then trap them and say, not trap them in a bad way, but if you're not going to do this, what are you you got all this money in your IRAs. You just told me you think future tax rates are going to be higher. I also told you there's no risk in this transaction, so you can put this money in here, and I don't want you to take it out, but if you need to, you can. You follow what I'm saying? And so what you're going to find in your practice is when you're sitting with your clients, if you identify that they've got money, there's one thing I can tell you, that if you ask them the question, what do you think future tax rates are likely going to be, and when they say higher, you're going to kick the doors open to opportunities that you may not even knew even existed. So that's single premium life. DC's got 6 minutes to finish, but is there any questions real quick? And you can call us, of course, anytime, but is there anything that you want to dig a little bit deeper on? Nick?
I want Aaron to, I want you to cover that case that you just did.
Okay.
But before, just to make sure that everybody understands, when he's talking about, you cannot put qualified money into this, right? So I know he talked a lot, but he's putting non-qualified money in this to pay the taxes on the qualified money upon death. So don't get confused that you can put qualified money in here, because it's a non-qualified transaction. Okay.
Following up on that, we do have a solution if a client has qualified money. It looks a little bit different, but you're right. Thank you. So real quick, we had an agency here in Nebraska that Nick and DC got me involved with when I first started, and we have an arrangement with them where they're really just in the med sub business. They know that there's opportunity, but they just don't have time to dip into stuff like this. And so what they did was they said, okay, we're just going to give you the name, you go sell it, and then we're going to do a split arrangement with you. Well, so I had an agent that called me up, or actually she sent me an email. Yeah. Yep. A week later, I get an email from the agent, said, hey, I've got a name of a client that's looking for whatever. And I said, great, I'll call her up. So I called up the client, and my first pitch was, hey, this agent, her name was Julia, referred me to you, and she was expecting my call, so it was completely warm. And I said, I know that we want to visit. My intention today is not to have that conversation, but I'd like to set a time to just go through a discovery interview with you. Fine. We do that call. I learned a little bit more about her. From there, I kind of went back to my drawing board and came up with some solutions. Ended up being a single premium life fit. Took that back to her. We had a second interview. She wanted a little bit of time to think about it. I told her we needed to apply to see if she could qualify for it. She agreed to that. We applied. She qualified. We ended up selling the case. It took about 2 weeks probably from start to finish. The agent took about 15 seconds to send me an email, and I made her $4,000 for sending me that email. We did all the work. And those opportunities exist for anyone that wants to have that kind of relationship. You can be as involved or not as you would like. This was a client that she actually sent me the premium check to my office in Kansas City. The lady doesn't know me, doesn't know who I am. She did call the agent. I learned a few times, hey, is this guy real that you sent? Because she sent me a check for $100,000, so it's kind of a big deal. But it's one of those things where it's completely comfortable, and it's because I and DC and I have been client facing for so long that it's another value add that we think we can bring to you agents and your clients, because you have someone that's been in your shoes before. We've been in the trenches not long ago. Still sell a little bit today. So we're completely comfortable, and we'll treat your clients just as they were our own, and you can feel confident that they're getting respect and so forth. So. Oh, that's even better. So then, after we get the case paid, wait, there's more. After we get the case paid, well, then I get a call from a random guy that I think was a random guy, and it turns out being the brother of this lady that wanted to do the same thing for himself. So that case is still pending. It's not done yet. But when I told the agent about it, and I said, hey, I just talked with her brother, Barry, and blah, blah, blah. Well, then the email that she sent back was something like, oh, that's awesome, Barry's loaded, or something like that. So we got hooked the whale. But guys, I will tell you, this is not a hard sale. It's not. And like I mentioned, when I said that clients before have said it's a no-brainer, I'm not kidding you. They literally say, this seems like a no-brainer. Where's the catch? This sounds too good to be true. And so you just take them through how it works, and I am amazed that there's not more of this sold, because it just makes so much sense to your client, especially when you've got your finger on the money in case something changes. The referral, she was 75. No, she was 72, Barry 75. Thanks, guys.